So what is it that we are going to study in monetary economics? Okay, what is it that we are going to study in monetary economics, and what is monetary economics all about? So what you understand is that as you are controlling each and every economy, all the economies of this world, okay, the component of money becomes very, very fundamental. Money is very, very important, a very broad subject, and it has got a lot of impact on your economy, okay, on the output of every economy. So under monetary economics, what we look at is the impact of the monetary sector. The monetary sector, that is to say the banks, what all those things, right? The impact of the monetary sector on what? On the economic activities. That's the main thing, okay? So we are applying economics, we are applying, we are applying the economics on the monetary sector, especially relating it to how it can help us actually to, you know, to solve most of the economic problems that we have, or how can it help us to work or to deal with some of the economic activities that happen. So that is what you deal with under monetary economics. So what is it that we'll be talking about? This is the journey that we are going to take. Number one, we'll start simple. We'll start with the functions of money, isn't it? We'll start with the functions of money. We'll define what money is and look at the function, the different functions of money. We will look at the evolution of money, right, and the payment system. The evolution of money and the payment system is very, very necessary. We need it, okay? So look at that evolution, the evolution of what? Of money, okay? Look at the evolution of money and the payment systems here in the country. So you see where money, like the payment system, how it started, right? We are aware that it started as far as from barter system, the first one. From barter system up to where we have now, where we have electronic system, we have money, we have e-money, isn't it? Like what are some of the stages, right? What are some of the stages that money has undergone so that it reaches where it is right now? So look at the evolution of money. We'll look at the functions of the central bank, right? We will look at the functions of the central bank mainly. And we'll start with the commercial banks and the central bank. The central bank. So after looking at the functions of the central bank, we will extract one of the functions of the central bank, which is money supply. Very important. We'll look at money supply and the whole process of money supply, okay? We will look at the mechanism of money supply in what is known as the monetary policy. So look at the monetary policy, which is basically the policy that guides the supply of money, okay? What usually happens is that the central bank, in this case, the Bank of Zambia in our case, the Bank of Zambia is mandated with power to control the supply of money in the economy. And that has an impact on the economic activities. So it is the central bank, the Bank of Zambia, that controls the supply of money. So the question is, do we have too much money in circulation? And what is the problem of us having too much money in the circulation? You learn those things under macroeconomics, isn't it? You learn those things under macroeconomics, right?
Yes.
So let me just ask you, what are your majors? Let me get again. What are your programs called? Mr. Moses, what is your program called again?
Economics and finance.
Economics and finance.
Yes,
is it the same with the
finance and the economics?
Okay, economics and finance.
Yes.
What about Wanyambe?
It's the same.
It is the same program. Okay, thank you. So I'm sure since you're majoring in economics, you did macroeconomics. You look at those things such as inflation. you will understand that one of the determinants of inflation is money, right? Money supply. When there's too much supply of money, I'm just reminding you that, right? When there is too much supply of money, what will happen? That will push the prices upwards, of course. So the central bank is very careful, the Bank of Zambia in this case. They don't supply too much money in the economy so that they don't damage the economy, okay? So if we have got too much money in the economy, the central bank should come up with a mechanism to reduce the supply of what? Of money, so that we have just enough. We just have enough, not too much, okay? And again, there are those times when you have too little money in supply. What happens is that the central bank should come in to do what? To increase the supply of money, isn't it?
Yes.
Yes. Yeah, to increase the supply of money. So what happens is that if the government or the central bank is increasing the supply of money, technically we say they are embarking on an expansionary monetary policy. Expansionary monetary policy is when the central bank increases the supply of money. Then the other one is called the contractionary, which is same as the restrictive monetary policy. The restrictive monetary policy is about reducing the supply of what? Of money. When we have too much money in the economy, we have to reduce the supply of what? Of money. Is that clear? So it is the duty of the central bank to control the supply of money. And that is what we are going to look at. There are some tools that they use, okay? The central bank uses some tools to control the supply of money, such as open market operations, OMO, the discount rate, all right? And the reserve ratios. When you look at those tools, we'll learn in detail how the central bank uses them to control the supply of what? Of money. They increase, if they want to increase, how do they adjust those tools? If they want to reduce, what do they do with those what? Those tools. Is that clear?
Mm-hmm.
We will look at the ISLM model. Very, very important model. I think that you looked at under intermediate macro. Did you do an intermediate macroeconomy?
Yes, we did.
Yes, under intermediate macroeconomics, you looked at the ISLM model, right? Which is the investment and savings model and the liquidity market. That is the ALM model. So the ISLM model, in short, we are looking at the point at which the goods market can equal the what? The monetary market, isn't it? The money market can be equal to the goods market, especially as adjusted by the interest rate, isn't it? As dictated by the interest rate. There's that point, that level of interest rate that brings into equilibrium the IS and the LM curves together, which means that the goods market and the money market is in what? Is in equilibrium. That is the idea of ISLM. I'll remind you about the ISLM. Is that clear?
Yes, please.
We will look at how money influences the economic activities. And I said already that the central bank uses some different tools to control the supply of money. So look at those tools. Then we will look at the theories, right? The theories that guides the demand of money. Those theories. You remember the Keynesian theory of money? The theories, right? That guides of the demand of money. So we'll look at those theories in detail. Okay, look at those theories and what influences the money demand. That is very important. Okay, what influences money demand? Money holding demand, right? People want to hold money, but the question is that why should people hold money? Why do people want to keep money instead of leaving the money at the bank, right? What are some of the motives? So you look at the Keynesian theory of money demand. Okay, we'll look at how the Keynesian which is John Maynard Keynes. I think you learned of this one of the fathers of modern economics, right? From 1936, that's Keynesian economics, one of the fathers of Keynesian economics. John Maynard Keynes, right? Yeah. So look at the Keynesian theory of the demand of money. Why should people hold money? You understand that according to Keynes, Keynes said some people hold money for transaction motives so that they are able to buy things on daily basis, right? Others hold money for what? For precautionary motives, right? Yeah. So people hold money for precautionary motive, and the others hold money for what other motive? What other motive?
Investments.
Okay. Okay. So others hold money so that they can invest. Others hold money because they want to wait for the other better opportunities, isn't it? Yeah. So you look at those things in what? In detail. That is under monetary economics. When you're done with that, then we will look at how to use the money to control, number one. How do you use money to control inflation? Okay. How do you use money to control inflation in the country? How do you use money to control the interest rate? Okay. You know that the interest rates are very, very important because they determine the investments, isn't it? What happens to investments if you have got high interest rates?
The risk
What
is
direction,
high.
what direction do they take?
Volatile, I think.
Okay. So what happens if you increase the interest rate, then the investments reduce, isn't it? Because it becomes very expensive to borrow money for loans and for investments. So therefore, investments reduce. There is that inverse relationship. So the question of the day is, what can you do with money to control the interest rates? That is what we'll be looking at. We'll also look at how to use money to control exchange rates, right? When you talk about exchange rates, that is just, they're looking at the appreciation or depreciation of the local currency against the what? The foreign currency, isn't it? Just that. That's to simplify the language. Okay, I'm trying to simplify that. Of course, there is a deeper conversation under international finance. When you do international finance, I don't know if you did it already. You have that deeper conversation around the exchange rates. Okay, and how you control, how do you strengthen the local currency, for example, in this case, the kwacha. How can you make sure that the kwacha is stronger? How can you make sure that the kwacha appreciates? Okay, what do you do in short? And why should you appreciate or depreciate the kwacha? That is called evaluation and devaluation of the local currency so that we don't have a problem in the economy. You know, again, if the kwacha the currency appreciates too much, it's a problem on the other side. Those conversations will hold in detail and what happens. The economic growth. We look at economic growth, like how do you use money to do what? To increase the growth of the economy. That is to say the gross domestic product, GDP. How do you control all that? And from there, I call for any question. Is there any question? Any clarity needed somewhere?
Not from me.
Are we together? So Moses, we are together?
Yes.
Yes.
Yes, we are.
Okay. So once we look at these things, how money is used to control this, you can see that these are some of the key variables that hold the entire economy. In short, how do we use money to control the economy? All right. How does money influence other variables in the economy? That is what we're going to look at. Then we'll look at the financial intermediaries, okay? The financial intermediaries. Now, the financial intermediaries, these are the institutions that bring together the lenders and the what? The borrowers, isn't it? There are those financial institutions that stand in between those people that have got too much cash, those are lenders, right? And those that have insufficient money, those are borrowers. So there are those institutions that are there to bring together these people, okay? We call them the financial intermediaries. We look at the various roles played by the financial intermediaries. Clear? Hello.
Yes, yeah.
Yes, sir.